Hi everyone. Hopefully you guys are doing well. Welcome to uh, ICAEW's corporate reporting class. I'll say, and today's our topic is that we need to do or we need to complete. That's IFRS 16 leases, right? So just for a formality and things, you have got the corporate reporting text as well. And if I talk about this particular text, you'll see that we are about to start this particular accounting standard, right? And more specifically, I'll say, since we have already covered borrowing cost in our earlier studies and government grants in our earlier studies, so we'll just be doing as of now IFRS 16 leases, right? So this is that we need to look for, this is that we need to do. And similarly, I'll try to cover all the frequently tested accounting standards before moving on to consolidation and then audit aspects, right? So just a brief guide on the syllabus, that this particular guideline is I'll say about ethics and corporate governance, right? This is the auditing thing, and remaining all are the accounting and things, right? And this particular thing is as well as audit, right? So ideally, the course that I'll say, it takes 2.5 months to cover, right? 2.5 months of regular classes. So if we target the July attempt, so ideally your study should start in later April or start of May, right? So this is the plan that we will be following, we should be following as well. I hope my screen and voice is clear, and you guys can confirm me on the LMS that you have seen this class and text me, right? So what's the SOP of classes? It's very simple, that we'll be doing or we'll be having, right? Accounting standards, right? We'll be obviously having a look on accounting standards, and once we have had a discussion on accounting standards, we'll do some ACCA SBR level past papers, right? And once the SBR, it will be very few, I'll say, right? It will be very few, and then we'll do ICAEW level past papers, right? And then we'll do ICAEW level past papers, okay? So uh, this is it. And in IFRS 16, I'll just tell you that we have two books to study, right? We have two books to study. One is lessee books that we need to study, and the other one is lessor books that we need to study. So I'll try to have at least three classes in which I'll have a detailed discussion on past papers as well, a detailed discussion on accounting treatment as well, right? The more importantly, we will I'll just give a guide to each and every student here, that should be, I'll say, should be very less focused, right? Students should be very less focused on accounting aspect, right? Rather than focusing on studies, I won't be saying that try to study different accounting standard. I'll say that focus more on practice aspect, right? Focus more on practice aspects. You will see that in this CR text, or you have got many recordings, right? You have got recordings to cover. So why waiting for all recordings to get ended, right? My suggestion would be that you shouldn't at all wait for the recordings to get ended. What you will do, you will, or you should just have to make sure that that you have done these past papers. I can guarantee you guys, right? I can guarantee you, if you guys start the past papers from here, like real exam July 15, Congloma, Heston, and you guys have all done the accounting standards in the previous studies, it doesn't matter that I am going to do or not. I will do the accounting standards with you, but it's you guys that have to make sure that you guys see do these accounting standards. If you guys have done the accounting standards still here, guys, believe me, your paper is passed. These are the questions that you have to do, and you make sure that you have done it, and before attempting in an exam. And obviously, I'll say that practice questions, I'll write one more thing here, guys, for you, that practice questions shall be done on software. You make sure that you guys are doing all the practice questions on software, not particularly on the paper or word or something. So is the software practices covered? Yes, software practice, software of ICAEW tutorial is being covered in separate class, right? I have taught you in a separate class that how you are going to practice on ICAEW's software, right? So these three classes, I'll say of 1.5 hours each, or I might take 3 hours straight class to close this particular discussion on IFRS 16, and then we can do some past papers as well. Okay, so now just a brief introduction of myself. My name is Abdul Basit. I am tutor of ICAEW and ACCA, and I'm an ICAEW, right? And apart from that, I have done ACCA and BSc as well, right? So I'm prime tutor for these qualifications specific to my expertise level. Corporate reporting is something that I've been doing from 4-5 years in one of the leading manufacturing sector that was previously a multinational and then acquired by the local owners, ICI Pakistan. I have been doing the reporting there from quite a long time and have a focused grip on these accounting standards, since I myself has applied these accounting standards there, right? So guys, shall we move on to the questions and then the practice on ICAEW, if you guys allow me? So here come the pages, right? So my again thing is that in IFRS 16 leases, we have lessee books and lessor books as well, right? In your earlier studies in ACCA, you must have seen lessee books very well, but here you have lessor books as well, right? But here you have lessor books as well, and in I'll say in the ICAEW level, you have lessor books as well, right? In ICAEWs as well, you have lessor books as well. Okay, so we'll do lessee and lessor. These are some practice questions that I want to share here, and we will be obviously doing these questions, but before that we need to have a brief discussion on finance lease and operating lease. Okay, so guys, let's have a discussion here. Leases, right? Now see, just wanted to tell you that this is the first IFRS or second IFRS we are doing, so it's IFRS 16, right? Previously I believe it was some IAS. I must have written a name here as well, IAS 17, yeah, right? Previously it was IAS 17, and obviously this was amended, right? And obviously this was amended and made IFRS 16. So guys, exactly what happened now, that's something interesting, right? Exactly what happened, it's that a concept of finance lease that came into the world, right? It's that concept of finance lease that came into the world, and then things got updated, right? Now let me explain you the major difference of IFRS 16 and IAS 17 that went to close because of this accounting standard was this term, finance lease. See what this accounting standard tells, right? Let me explain you that what this accounting standard tells. It's just tells you that there are two type of leases, right? It's just tells you that there are two type of leases. One is finance lease, that's long-term lease, and the other one is operating lease, that's short-term lease, right? There are just two types of leases. One is finance lease, that's long term lease, and the other one is operating lease. In IAS 17 there was much more focused on operating lease, right? Because things were going in that way that everyone would recognize the operating lease. But then there was some malicious practice, there was some I'll say artificial accounting and kind of that creative accounting, and it went on to some huge blunders. Therefore a new accounting standard came, and it restricts the operating lease and ensure that every lease should fall under finance lease. Quite left if you can go for operating lease. Now see what happens is, the first thing that IFRS 16 tells you, right? This is the most important thing I'll tell you, right? This is the most and the foremost important thing that I'm going to tell you is that this is lease. And what it tells you, what is finance and what is operating lease. Now if we explain that what exactly is finance lease, guys, if we explain what exactly is finance lease, so it's just like you have bought an asset. Finance lease is just like a lease that you have bought on asset. And therefore since you have studied this accounting standard earlier, you must be remembering right of use assets being recorded, finance lease obligation being recorded, FLO and ROUA. This is the accounting of finance lease, and obviously this will be covered later, right? So this is the accounting of finance lease, and obviously this will be covered later. But the thing is that what happens is, it's that finance lease is a separate lease that needs to be recorded as a separate asset, right? And then we have operating lease. Now what's operating lease? It's treated as that you have taken an asset on a rent. It's treated as that you have taken asset on rent. The thing is that if you are going for finance lease, sir, what's the difference between that? We will be doing it. See, we have a difference here, don't worry. If you are taking an asset on finance lease, so that means you are going to record that lease as an asset. But if you are taking an asset on operating lease, then obviously it would be treated as a rental obligation. Now sir, how we can recognize that whether this is a finance lease or operating lease? Obviously, how we can recognize it, huh? So the thing is, you need to analyze that whom, right? You need to analyze whom asset is spending maximum lives on, right? Whom asset is spending the maximum life on. If asset is spending the maximum life, with lessee, the one who have leased an asset, right? So it would be treated as finance lease. Like if I've leased a car, and that car is being used by myself with the most of its life, so that asset needs to be recorded as finance lease. But if that car is just for one day, remember, if that car with me is just for one day, right? So I won't be recording it asset, it will be an operating lease. It will be a short-term lease, and it's for short-term period, and the maximum life of that asset in operating lease would be with lessor, the asset owner. It would be having of that, right? So in finance lease, repairs and maintenance is lessee's responsibility. Guys, if you're going for finance lease, so repairs and maintenance are just with the lessees, right? Repairs and maintenance are just with the lessees, and if any expense on repairs or maintenance is done, it's whom it's going to be incurring. It's the lessee is going to incur, right? And then obviously you need to record the assets, since if you're taking on finance lease, you will be recording right to use asset, and we'll do the accounting, don't worry. And finance lease obligation needs to be recorded as well, right? As finance lease is a loan, that's why lessee's rental paid are treated as a repayment of loan, Sir, what's this? Sir, what's this sentence? Don't worry, I'll explain you in an example, right? Don't worry at all. I will explain you this particular thing as an example. So it's for short period of time, and no asset is recorded in lessee's book in for operating lease, and no obligation in the books of lessee. Just treat rentals as an expense, right? So if now let me give you an example. If I am taking a car for 5 days, right, just for rent, I'm in UK, let's say, and I'm taking cars for 5 days. So if I'm taking the cars for 5 days, that means that I will be uh, using the car for 5 days only, and the car's life is, let's say, 20 years. So that's lease, is an operating lease. I'll just be recording the rentals of car as an expense. But let's say I've got a job in UK, and the company is giving me a car, and it's from bank leasing, right? So now the car owner would be me, right? But I'll be paying some money to the banks so that I can drive the car. Now that lease, since the maximum life of the asset pertains to me, so I'll be recording that asset, and I'll be paying some liability of that's finance lease obligation. Whenever guys, believe me, whenever you will be having an operating lease, it's a very simple accounting, right? It's a very simple accounting, that you just need to rent out the expenses. That's it. It's a very simple accounting, that you just need to rent out expenses. That's it. But when it comes to finance lease, it's some extra accounting work needs to be done, right? So just a brief summary, before that we move on. It's just a brief summary that what are finance leases. It's a long term leases, and in long term leases, the right of asset belongs to the lessee, because asset spends most of the time with asset is spending most of its time with lessee, and its maximum life is with lessee, and so lessee would record a asset and a liability. And so how this would done, I'll explain you in the next page. Whereas in operating lease, the lease is very for short term, and I'll give you a criteria explaining here as well. Let's see, the new IFRS 16, what exactly changed from IAS 17 to IFRS 16 is this accounting. That IFRS 16 said for lessee books, IFRS 16 said for lessee books, all leases are treated as finance lease. Simple as that. For lessee books, all leases would be treated as finance lease. That's it, right? All leases are finance lease, except now in IAS 17, that means you have an option to book finance lease and operating lease, right? In IAS 17, you have an option to book finance lease and operating lease, right? You have an option to book, okay? But in operating lease, in IFRS 16, in IAS 17, you have options. It is said that all leases are finance lease until and unless lease with a lease term less than 12 months. If you have a very shorter lease term, right? If you guys have a very shorter lease term, like less than 12 months, so it would be treated as an operating lease, right? And if you have an low value asset, so it would be as an operating lease. So sir, that means the main difference between IAS 17 and IFRS 16 is the difference of finance lease. Like in IAS 17, you have option to go for finance or operating, but in IFRS 16, you have to, in IFRS 16 you have to go for what? In IFRS 16 you have to go for finance lease until and unless it's a lesser than 12 months leases, or it's a very low value asset. And guys, in this low value asset again comes the subjectivity. That means, let's say I've bought an iPhone. Now for me, iPhone is a material asset, but for billionaires iPhone is immaterial. So it depends on organization, that whom they regard as I'll say low value. It depends on the organizations that whom they regard as low value assets. You got this? So guys, all leases are treated as in finance lease. So guys, all leases are treated as in finance lease. That's the main difference in IFRS 16. The leases which are very lesser tenure, like it's 1 month, 2 month, 10 months, so it would be treated as an operating lease. No asset would be recognized, only rentals would be recognized. And if it's a low value asset, and low value assets depends on organization. If organization has 10 cars and one car is being recorded as an operating lease, so it would wrong because it's a material thing. But if let's say if organization has Ferrari, if organization has Porsche, if organization has Bugatti, and they are just operating lease Suzuki Wagon-R, so we can say that yeah, it's a low value asset for them and it could be treated as an operating lease. So as an auditor, you need to look for these two things if they have made operating lease, right? So sir, what exactly the difference in, now see, why would, now think of it, why would, now think of it, that why exactly would I would recognize finance lease? Why would I not prefer operating lease? Guys, everyone, believe me, everyone would prefer operating lease. It's less accounting being done, right? Assets are not being recorded so that your balance sheets are not going up, right? And you will see the accounting practices that's been done in finance lease. It's quite difficult as well, and it's quite I'll say have a working mechanism, administrative burden apart from some disclosures. So I myself, at time of applying IFRS 16, I really wanted not to do that because I was very new to it, right? So people were not that much, and this IFRS has an accounting implication as well. It would be giving you a huge cost as well. Now we'll see that, okay? We'll see, and we'll give you the example of some big brands like ICAEW Pakistan, like Khadi, why they do not wanted to record it the finance lease. It's very simple that in operating lease there's no accounting. It's just the rental expenses that needs to be recorded, P&L debit, and then cash credit. But in IFRS 16, you need to record the asset and its subjective liability as well. In IFRS 16, what happens is that you need to record the asset and then you need to record its subjective liability as well, which causes a problem a lot, right? Which cause a problem a lot. And it gives you a financial impact as well. It gives you an administrative burden as well. There were people in IAS 17 wants every leases to be go on operating lease, but then IFRS 16 came and made sure that every leases is treated as finance lease, because this gives you the substance over form concept. I know you have forgotten that. Don't worry, I'm going to explain each and everything, buddy. Don't worry at all. I'm going to explain each and everything. So a brief covering of this page as well, right? A brief covering of this page as well. So what's the initial entry in finance lease? I told you that whenever the finance lease is recognized, just remember that you need to record it right to use asset, and then you need to record lease obligation, right? So basically, if you have taken anything on finance lease, it's your asset. So you will be recording a right to use asset because it's your right to use that asset, right? But ultimately you have some liability to be paid off. Now if I take a car on bank loan, so bank has given me a right to use its car, so that means it's my car, but ultimately bank would take the finance payments from me, so these are going to be lease obligations. So if we enter in the world of IFRS 16, we'll see that there's a finance leases, and in finance lease you need to record an asset, and that asset would be depreciating as well, and lease liability as well, that needs to be paid via rentals, right? So present value of minimum lease payments, right? So present value of minimum lease payments would be the value of it. You will ask me that's a on which thing lease obligation would be recorded, on which amount, right? So what I'll do, I'll calculate all the obligations. I'll calculate all the obligations that I need to pay and would convert that into present value. So present value of minimum lease payments. So how this amount is being calculated in the next page, I've given you the example. So guys, a brief revision. This is the main accounting standard. That's it. Accounting standard is done. We have some other things as well, but this is the main thing. Now we need to do practice and we need to have some components to be discussed. Very clear, very assertive that IFRS 16 just came to make sure that every lease is being recorded as an finance lease. This is what IFRS 16 came. That's it. Because in IAS 17, everyone would be preferring to record operating lease. IFRS 16 came and said, okay, everything would be on finance lease. That's it. Right? And in that finance lease, if you want to go operating lease, you have to either sign a lease agreement of, I'll say, 11 months, right? Not the 12 months, because if it's more than 12 months, it will be treated as an operating lease and that asset would be a low value asset. Otherwise, if any of the condition is breached, if it's for 13 months, it's your asset. Then you need to record it as in finance lease, right? So what happens in finance lease, you'll record the asset and you will do the present value computation and would record a obligation as well. So asset and obligation being debit and credit. So asset would be depreciated and obligation would be settled. Sir, how that accounting treatment is done, guys? This is done here. Don't worry, I'm going to explain you. Don't worry at all, I'm going to explain you. And then guys, this is the question bank. In this question bank, we have many questions of IFRS 16. What are you thinking, huh? What are you thinking? There are many questions of IFRS 16. See here, IOP, it's totally on IFRS 16 questions as well, right? So don't worry, we will be doing these questions, huh? Don't worry, we will be doing some questions in which ICAEW's level questions, and more importantly, we will be doing on practice platform now. More importantly, we will be doing on practice platform now. So this is the main concept that I wanted to give you. So make sure everyone while doing the practice have remembrance of this rule. Just remember it, right? And everyone have remembrance of this rule, like what's the accounting treatment of finance lease and what is the accounting treatment of operating lease, and what's the main reason that IFRS 16 got implemented. It's just to make sure that every lease is being recorded as an finance lease, right? And I'll give you the impacts as well, that why people don't want to record the finance lease, because it gives them a major financial impact. Their EPS gets moves, and I'll explain it later, right? So I hope you guys have got this. We would be doing some practice questions, then ICAEW level questions as well again. But before that, I would request you that you guys should go on 755 page number, right? Just to show you some things, right? Because now the paper is near. So 755, let's go by here. It's 8:33, sorry. What I'm saying is, and since I've taught you the initial concept, right? I've taught you the initial concept, you should start reading this as well, right? You should start reading this as well, that leasing arrangements, agreements in IFRS 16. What is a lease, right? A contract or part of a contract that conveys right of asset in exchange of consideration. So that's the definition. An asset is subject of a lease for its right to use has been provided by lessor to a lessee, right? So some brief definitions identifying a lease, right? So how leases can be identified. Now these are the definitions of accounting framework, right? But you should be knowing it. Obviously these definitions wouldn't come, but what I want is that you should at least go through this bookish example as well, so it would help you to determine that how this wordings would done, right? So lessee accounting, then we have lessor accounting, and don't worry, I'll cover all thing in my notes. But guys, whichever standard I am saying you, book reading of few standards, I am requesting everyone to have it, right? Book reading wherever I'm writing. So a few standards is very important, so you should be having a look onto it, right? You should be having a look onto it. You should be at least discussing the book reading of those few standards. So I'll request you that have a reading on IFRS 16, right? Have a reading on book reading of IFRS 16. That this text is available in the LMS. This question bank I'll be solving with you guys as well, and this is the leases complete chapter that I'm going to teach you. But do some book reading by yourself as well, right? So guys, is everything clear till here? If yes, then tell me and we can move on. Yeah, guys. So we had a detailed discussion on the initial practice of IFRS 16, right? Just a brief overview that what exactly is going to happen is that the main aim of IFRS 16 would be, right, the main aim of IFRS 16 would be that all the leases would be termed as a finance lease, right? And in finance lease, the accounting treatment is very simple, that you will be recording uh, finance leases, and you will be recording a right of use asset and a finance lease obligation, and how the working will occur. So we would practice that in the upcoming time, right? So I believe now you got the main aim of IFRS 16, right? So now let's have some practice question. We discussed this in the previous part, so let's have a discussion on this question, right? That how this thing would be done. I will just write that we are totally right now practicing for finance lease, okay? So we are right now practicing for finance lease, and obviously for the upcoming time we'll then see what else we can do an operating lease. Operating lease is very simple. The treatment is quite very simple, and the things are very easy, that can be done at an easy manner. Okay, so inception of lease is 1st Jan 2006. That means the lease conditions were met, right? The lease conditions are met. Sir, can we have a look onto the lease conditions or recognition of lease? So yeah, you can go onto the book and have an idea of that as well. Do read this text, huh? Whichever accounting standards we have covered, do read this text definitely. Sorry. So here it is, the recognition of lease, right? Identifying a lease. So how the leases are identified, it's very simple. That a contract deemed to contain a lease if conveys right to control the use of an asset for a period of time in return for consideration. So that's a lease, right? If you have received, and in the practice questions, obviously the lease conditions would be met, but in exam there can be things that you can see that, oh, lease conditions are not being met, and still they have done this. Okay, so the right to control the use of underlying asset depends on the lessee having right to obtain substantially all the economic benefits and right to direct the use, right? So economic benefits and the use has been determined by the lessee. Okay, so the asset must be identifiable, right? Specified in the lease, maybe part of an asset. So you have to go through this, right? The accounting treatment is, I'm going to tell you, don't worry on that. Okay, see just in uh, this book, and do have a read on that. Okay, these examples are very good as well, that whether it is a lease or not. Let's have a look onto this as well before going on to the practice. Okay, so now what they're saying is that Big Farm Limited has 3 Fessy Mergerson tractors under contract from Agri Rental Limited. The tractors are leased for 5 years, during which Big Farm Limited uses and keep them on the farm, and they cannot be retrieved by Agri Rental Limited. Agri Rental Limited will supply a replacement tractor if any of the 3 requires servicing or repair. The tractors are returned to Agri Rental after 5 years. So is this a lease? So definitely this is a lease. Now, so why this is a lease? Now, here comes a question now. So why this particular thing is a lease? Because it's an identifiable assets, right? And Big Farm Limited has the right to direct their use. Big Farm Limited will decide that whether they would be leased or not, right, for the period under, and substantially all the economic benefits for the 5 years from them, right, cannot substitute or swap one of its tractors until it requires repairs. So that means uh, just whenever agri rental want, they cannot just change it. Yeah, when they think, right, yeah, when they think that the repairs are due and some kind of things are due, so they obviously change it, okay, and they can, so therefore this would be a lease, right? Then worked example 2, is it a lease? So Big Farm Limited also has the use of two combined harvesters under contract from Agricultural Limited. The contract agrees, okay, so two combined harvesters. Then we will have access to combined harvesters which have vario cutters, okay. However, Agri Rental can decide on the brand and specific machine supplied to Big Farm, albeit with vario cutters. As harvesting is not year-round activity, Agri Rental retains the combined harvesters at its depot but will supply them as requested within 24 hours. So that means, that means, that means, yeah. So now this is not a lease, right? Sir, why this is not a lease? There must be the questions, right, that why exactly this is not a lease. So the things are very clear, that there are no identifiable assets, right? The combined harvesters, they are not separatable, right? Then, and although Big Farm Limited has the right to use the machines for a period of contract, can decide upon the actual combines provided to Big Farm. So therefore the contract is not classified as a lease and a rental payment should be expensed to profit and loss. That means this was not a finance lease, this was an operating lease, okay. Then workbook number 3, is it a lease? So Out and About company provides tours round places of interest in the tourist city of Sightsee, right? While these tours are mainly within the city, it does the occasional day trip to visit tourist cities further away and has entered into a 3-year contract with the fast coach company. So now what has happened is that Out and About company is basically a tourism type of a thing and a festival and just do these things, right? So while uh, these tours are mainly within the city, right, it does the occasional day trip, okay, it does the occasional day trip uh, to visit tourist sites further away. Out and About company has entered into a 3-year contract for a fast coach company to use one of its coaches, right, for this purpose, and the coach must seat 50 people, but fast coach can use any of its 50-seater coaches when required. Now again, if you do not have the right to use it exclusively and it can be used by anyone, so this is not a lease, and this is the reason. This is the reason you should not be just answering that what is lease and what is not a lease. You should be saying the exact reason that what exactly it's not making it lease, right? So there is no identifiable asset. Fast coach can substitute one coach for another and would drive economic benefits from doing so in terms of convenience. Therefore, Out and About should account for rental payments as an expense. Then, oh, there are many, I'll say, okay. So it's great, huh? It's great. I'll say just do read this, huh? Do read this. These are really good examples, and I'll definitely say whoever is giving corporate reporting or technical case study, whoever is giving, make sure that make sure that they are doing or reading this text, right? So now, Coketown Council has entered into a 5-year contract with Carefleet Co., under which Carefleet Co. supplies the council with 10 vehicles for the purposes of community transport. Okay. Carefleet Co. owns the relevant vehicles, all 10 of which are specified in the contract. Coketown Council determines the routes taken for community transport and charges and eligibility for discounts. The council can choose to use the vehicles for purposes other than community transport. Okay, so councils can use it, right? For any reason, not just for the purpose of that community. When the vehicles are not being used, they are kept at the council's offices and cannot be retrieved by Carefleet. Coketown Council defaults on payment. So, if a vehicle needs to be serviced or repaired, Carefleet is obliged to provide a temporary replacement vehicle of the same type. So, I believe this is a lease. This is just common sense, okay? This is a lease. So, there is an identifiable asset, the 10 vehicles specified in the contract, okay? Then, the council has a right to use the vehicles for the period of the contract. Carefleet company does not have the right to substitute any vehicles unless they are being serviced or repaired. Okay. Therefore, Coketown Council would need to recognize an asset liability, its SOFP. That's it. So accounting treatment, what is it? I'll tell you, don't worry. I'll tell you in the upcoming time what is accounting treatment. Then worked example 5. What is that? So now this seems a pretty much interesting thing. Let's have a discussion on that as well. Okay. Couple enters into a 10-year contract. I believe more than 12 years. It's a lease. It's a finance lease. But let's see. Utilities company for the right to use 3 specified physically distinct dark fibers within a larger cable connecting north town to south town. Okay. So we have right to use of 3 specified each and everything that I mentioned. Then Couple makes Couple makes the decisions about the use of fibers by connecting each end of the fiber to its electronic equipment. Couple lights the fibers and decides what data and how much data those fibers will transport. If the fibers are damaged, Telenu is responsible for the repairs and maintenance. Telenu owns extra fibers but can substitute those for Couple fibers only for reasons of repairs and all that. So this is a lease. Why this is a lease, sir? Specified asset, more than 12 months, substitution rights are still with the real owner, with the leased owner. So the contract contains a lease of dark fibers. Couple has the right to use 3 dark fibers for 10 years. There are 3 identified fibers. These fibers are explicitly specified in the contract and are physically distinct from other fibers within the cable, and they are dark fibers, right? Telling you cannot substitute the fibers for any reason, maintenance or malfunction. So they have referred the IFRS book as well. One of the student asked me that, sir, do we need to read the IFRS book as well? So no. I personally have used IFRS book in order to gain understanding when I used to apply a particular standard in my corporate world, right? But it's not mandatory to be read. If you have just read this IFRS, this is fine, right? Couple has the right to obtain substantially all the economic benefits from the use of fibers over the 10-year period of use. Couple is exclusive use of fibers throughout the period. Couple has right to use the fibers. The customers has the right to direct how and for what purpose the asset is used during the whole of its period, and the relevant decisions about use are predetermined, and the customer can operate the asset without the supplier having the right to change those operating instructions. Okay, so Couple makes relevant decisions and each and everything. So whether that was a lease or not, so that was a lease. Okay, then recognition exemptions, I'll just suggest you to read this, please. Read this, please. Whenever you can not recognize the finance lease. So I told you this is basically operating lease. I told you that short-term leases that are 12 months or low value assets. So they have explained you here as well. So I believe now we had a great discussion on IFRS 16. Now let's have a discussion of practice as well. Okay, let's have a discussion on practice as well. So whatever we'll do the practice is for finance lease, because for operating lease it's just one single entry. Which entry, sir? P&L debit, cash credit. Means operating lease expense debit and cash credit, right? So it's just one single, I'll say, entry here. Yeah. So inception is 1st Jan 2006. Okay. Lease term is 3 years. Okay, interest rate implicit in the lease is 10%. Rental is 10,000 per annum in arrears, right? And then present value of lease rental is 24870. So present value is 24870. This needs to be self calculated, but since it is, so we will assume that it is. But when it comes in question, they might ask you to self calculate it, right? And financial statement extract for the year 31st December 2006, this is it. Okay, so FS extract is this, and we have got this question of finance lease. So on which amount the asset would be recorded, its previous its or the liability would be recorded in finance lease. And so are the condition of leases are met? Yes, they are. We are assuming here. Okay, so the entry would be, the first entry would be right to use of asset, right? And this would be done on the recognition date. What would be the entry, sir? The recognition entry would be that you will be recording a right of use of asset at 24870, that's been debited, and finance lease obligation being credited, right? So right of use of asset and finance lease obligation being credited, right? So ROUA debit and finance lease obligation credited. Okay, ROUA debit and finance lease obligation credit. That would be the first entry, the recognition entry, right? Now asset would be dealt separately and depreciated, and finance lease obligation would be amortized through amortization schedule, lease amortization schedule. I can give you an example that when I joined my company, I remember that there were too many leases because our company used to provide loans to employees, right, and get them cars. So those cars needs to be in the lease cycle, right, because auditors were fighting with us. So that made some big impacts and big working hours, because what we need to do, we need to record the right of use of asset and a finance lease obligation. Then this needs to be amortized through here, and this needs to be depreciated. Now in order to, for the asset thing, right, there are two works that we need to do in the finance lease, right? It's a 3 years finance lease, so we need to depreciate the asset. So what I'll do, I'll just depreciate the asset with simple, that 24870, that 24870 divided by 3, so it's 8290 per annum, and it will go, and I need to give the extracts, right? I need to give the extracts. Take a picture of this, so that when I'm solving the question you can take it. So financial statement extracts, that means FS extract means that you need to show that what amount is going into P&L, right? FS extract means that what's my P&L impact and what's my balance sheet impact. You need to do it, right? What's my P&L impact and what's my balance sheet impact. Okay, so this was the thing that we were supposed to do. So this would be simply depreciated and would be used for 3 years. So see, rather than taking a complete hit of rentals of 3 years in advance, we are just depreciating it over the 3 years. The asset work is done. Now comes the liability. Now this liability needs to be paid off, right? This is the present value of minimum lease payment that we need to do the payments in 3 years, right? And what are the rentals? Yeah, the rentals. What were the rentals? So rental is 10,000 per annum. Okay, and present value is this, and interest rate is 10%. Okay, so now amortize this liability. How? So this is 1st January in 2006, no rental, no finance cost, no decrease in finance lease obligation, and this was my liability. Use this format, right? Date, rentals, finance cost, decrease, and balance. So this is the balance now. Whole year being passed, right? Whole year being passed, and this is the payment in arrears, right? Because 1 year has passed and you are paying. Sometimes you might get a case that you have paid in advance, right? Sometime you might get a case that you have paid in advance, and we will see it. But currently this is 24870. So for 1 year, what we need to do, for 1 year we need to pay off the rental. Now this rental includes, remember, this rental includes the liability element as well and the interest element as well, right? So this element includes the liability element as well and interest element as well. Okay. So 10,000 is your rental from which the finance cost is 10%. Now you don't need to do this working in exam. You need to evaluate whether the examiner has done right or not, right? So 10,000 rental to be here. Finance cost is 2487, 10% of that liability. So in 10,000, if 2487 is the finance cost, so how much you have paid for the actual liability? So how much you have paid for or in against of actual liability? So it's 7513. So 10,000 2487. So it's 7513. So that means this 7513 needs to be deducted from here, 24870. This would be decrease in your finance lease obligation because you have depreciated the asset and you need to treat it separately through the lease amortization schedule. Now, what happens? You paid 10,000 in advance, so you paid it like that this is 2487 for the finance cost for the accounting treatment that my tutor has told me, and this is 7513 in the rent. The owner doesn't care about this. They'll just take 10,000 and go home. They'll just take 10,000 and go home. Okay. So 2487, and then this would be deducted from here, and then 7513. So it's your balance payment. Now again, whole year passed, 10%. Now this 10% of finance cost would be applied to the previous closing. So now the previous closing is 17357. Now the previous closing is 17357. So 1735. Now in this 10,000, my guy, in this 10,000, my boys, 1735 is interest. So the liability element is 8265. So in 17,357, if 8265 is being paid, so how much is left? 9092. How much is left? 9092. Now the third year, the last year of leases arrive, and at 31st December 2008, you paid 10,000 again. The finance cost would be calculated on the previous original balance or previous opening balance, that 9092. So finance cost would be 909. That means when owner came and you paid them 10,000, it was 909 for the finance cost and 9091 was the finance lease obligation. So that means if you have paid 9091, so that means this is 9092 being your liability being paid off. Now just for understanding purpose, what happens is this was your actual payment that needs to be paid, right? This was your actual payment, I'll say 30,000 that needs to be paid, but initially what you did, you just get that in the present value of 24870, and I believe you know how to calculate in a present value, 1 upon 1 plus r power n. So 30,000 was the rentals, so into 1 upon 1 plus r raised to power n, so it's 10% and raised to power 3. So that was the present value of those things, and then you unwinded it, right, through lease amortization schedule. So that means this would be the finance cost of per year would be going in P&L. This would be your current liability if you want to report here, right? Let's say, so this would be my current liability, this would be my non-current liability, because this is the total one. Similarly, if I'm here, so this would be my current liability and this would be my non-current liability, and this here would be the balancing total of that, right? So how to make the extracts? Very simple. What would be the P&L impact? It's depreciation, that's 8290, and that year's expense, right? That year's expense. So 8290 plus 2487, so it's 10777, right? 10777 being recorded as an expense. And here in SOFP, the asset side would have right to use of asset 24870 minus 8290 being depreciated, so 16580 would be my asset, and liability at this year, because I'm making the extracts of this year, right? And liability would be current would be so my liability at the year end is 17357, and current is 8265, non-current is 9092. So 8265 is current and 9092 is non-current. Okay, so you sometimes you need to give breakup in current and non-current, so that's just the logic, that what are the numbers here, these are current, and what are the numbers are here, these are non-current. And sometimes examiner might ask you to make an entry. So what would be the entry? The entry is simple. The first entry is this, and then this chart needs to be entrinized, right? And then this chart needs to be entrinized. So how the entry would work is simple, that you just paid out the rentals, that's cash, so it's rentals, right? You just paid out that. Okay, you just paid out these rentals here. Okay, then the difference is interest expense, that mean debited, right? So 2487 is the interest expense, that's 10% of the liability you made it here. I found this table very easy. I personally think this table is very easy, right? So 24870, that's it. And then we have, right, and then we have finance lease obligation, which is balance of it, right? So 10,000 minus, so it's basically calculated as a balancing figure. See, I've written the balancing figure, that means 10,000 minus 2487, so it's finance lease obligation, right? So this is particularly, this is, I'll say, particularly the accounting entry of the year, or the line that we are supposed to make. You can do through this or through accounting entries, but both should be known to students, right? If there are any questions, guys, please ask. If there's any question, please ask, guys. Otherwise, see this working, and we can have an other question to be done. Okay. So any questions, guys? Do leave me a text on WhatsApp, please. Yeah. So I believe this question was easy. Why not? So why are you asking us to do the practices of these financials when they are not being able to test an exam? See, guys, obviously examiner won't ask you to calculate the facts, but examiner would test you the calculation. They would give you and ask you to identify the mistakes. So it's my personal belief that one can only identify the mistakes, right? One can only identify the mistakes when he personally have done the calculations and questions, right? So this is my personal belief. So therefore I would practice you these basic questions, and then I'll take on to you to the ICAW's things, right? So then I'll take it. So this is it. Please do this question too, and then we can move on to the other case as well. Then you have 2 minutes, right? Yeah, guys. So the question is easy, I believe. Question is easy. Take the picture and you can take it from here, right? I've solved it, so you can have a look. Question three is a bit different, so I'll get that solved as well. But you can take notes from here. If there's any question in this solution, you can ask. Otherwise, we can do the question three, in which the payment is in advance. So far, if you think in these both questions, the payment were not in advance. The rentals were paid once the years passed. But in the third question, you'll see the rental is being paid before. So you just have to look the workings, and if you are satisfied with the answer, we can move on to the question three. Okay. Yeah, guys. So answers are matched. Yeah. So let's have a discussion, guys, on this IFRS 16 uh, to yeah, prepayment case, right? So now question one and question two is being done, right? And I believe the answers are matched. If not, so you can text me as well. But now comes question three and question four. So now this is an important fact. Okay. Now what's this? Question number three. It's very simple. Inception of lease is this: lease term is 3 years, interest rate is 10%, rental is 20,000 per annum in advance. Now, here the case was that rental was in arrears. That means the rent was paid on 31st December. But now here, the rent or the case is quite different. Now what happens here is that the payments are not being paid in arrears. They are paid on advance. That means this is the date on first payment. So accountingly, I believe you guys have understood the concept. So what would happen is that initially, whenever you solve the question, you make this empty, right? Initially, whatever the question is, what you do, you make this empty, right? But now, since the payment is not in arrears, the payment is in advance. So what would happen? You will obviously get the rental here, and that rental would have no finance cost, because the day you are paying the advance because the day you are paying the advance, there is no interest charge, because interest charge over the year. But the day you are paying the advance, there isn't any year past, so there isn't any interest cost incurred. So that rental that paid on first day would directly recorded in decrease in FLO. Sir, we cannot understand this. Can you please explain it through the example? Yeah, have a look onto that, please. So now 20,000 is in advance, and they haven't given you the present value. So they have given you the annuity factor, which is discount rate as well, for 3 years. So they have given you that. I believe you remember the formula 1 minus annuity, how annuities are compared, right? Or how discount factor has been calculated. It's 1 upon 1 plus r raised to power n, and 1 plus 1 minus 1 plus r power n upon r. This was the formula of annuity. So the things are same, right? You have got this in financial management. So they have given you this, and we'll calculate the present value, no problem at all. Let's have a discussion on question 3. So now first year rental is in advance, so it's very interestingly a very good thing, right? So first year rental is in advance, that's 20,000. Second year and third year would be paid after. So second and third rental is 20,000, then into the annuity factor. So future value into annuity factor is present value, right? This is purely financial management thing. I haven't done anything as of now which is of reporting. This is purely and specifically financial management thing. Okay, so 20,000 into 1.736. So it's this is your I'll say total cost, and the present value of minimum lease payment would be 34,720 is the present value of these 20,000 or these 40,000 that are being paid for the later 2 years, and this 20,000 is the present value of, and this 20,000 is the present value of this. Okay, so 34,720 and then this 20,000. So its present value of minimum lease payment is 54,720, right? It's 54,720. Now this is the thing, this is the treatment, this is the value of present value of minimum lease payment on which the question would start, right? So again, date, rental, finance cost, decrease in FLO, balancing FLO. So date is 1st January 2006, right? So date is 1st January 2006. The rental is 20,000. Finance cost is 0. Why? Because it's the first year, first day you paid the advance. First year, first day you paid the advance. So no rental cost. Then there's a decrease in FLO, and then we have balancing FLO. So balancing FLO would be 54,720 minus 20,000 is 34,720, which was this, obviously. The 2 years advance payment, the 2 years minimum lease payment. Then on the next year, it's 20,000. That's rental. On the next year, it's 20,000. That's rental. And then since whole year is passed, so finance cost would be incurred at 10%. So 34,720 into 10%. So that's going to be 3472, and now this 3472 would be deducted from 20,000 because the second year advance that you have paid, it's basically 1 year's interest and the decrease in FLO as well. So 3472 would be deducted from this. So 16528, and then 16528 would be deducted from this. So that's the balancing FLO, right? So it's the amount that you have paid in respect of liability. So that's 18192. Then in 18192, 20,000 is again being paid, for which 18192 is basically an interest cost. So this minus this, so you have got 18181, which is nearly making it 0 because the numbers are assumed, so it's nearly making it 0. So this is how the advance cases are there. So in areas in advance, it's just the treatment difference of this, and present value of minimum lease payment would include the advance payment as well. Present value of minimum lease payment would include the advance payment of as well. Then sir, depreciation, it's simple. Present value of minimum lease payment would be the asset thing. So I'll record an asset here, ROUA asset, that's 54720, and finance lease obligation, that's 54720, and then this 54720 divided by 3, so this would be my depreciation per annum. This would go in the first year's P&L, or I'll say in 31st, yeah, in 31st December 2006, so 18240, and the finance cost that incurred on this year, this was pertaining to the previous year, right, 31st December 2006. So this would go here. SOFP would have an asset, but asset of how much? So it's 54720 minus 18240. So this would be my asset, and finance lease obligation at this point, is simple, that this all needs to be paid in current, right? So sorry, this is my liability after first year, and this is the current liability, and this is non-current liability paid after the year, because this would be paid within a year, the day we are talking about this, and this would be paid after a year is passed, right? So 16528 and 18192. Okay, so this is finance lease obligation of yours, right? So any questions in here, please tell me, guys. Any questions in here? Yeah. So guys, one thing, this question 4 is your homework. This is again the same thing, so do it and submit it to me, please. So this is again the same thing. Do it and then submit it to me. Okay. Now identifying a lease, so we have done that. Is it a lease? So we have done that as well from the ICAEW's book as well. Okay, so these things are done. And now some important facts here that I want to discuss. Yes, before going on to the sale and lease back, right? This is an interesting chapter of leases, so we'll do it a little bit later before we have to discuss this, right? So if lease term and life of asset is difficult, huh, or different. So if lease term is different and life is different, let's say if life is 10 years but the asset is being leased for 9 years only, right? If the life is of 10 years but asset is being uh, just leased for 9 terms, so what will happen, huh? If normally in this normal case scenario, things would be lease term and life would be same, right? So if an asset is expected to be transferred to lessee at the end of its lease, then always depreciated asset over its useful life. Sometimes examiner would write that towards the end of its useful life, asset would be transferred to lessee. It would be mentioned that towards the end of its useful life, asset would be transferred to asset. So in asset would be transferred to lessee. So in that case, the depreciation would be taken over the useful life, because at the end of the lease term, asset is of lessees, not of lessors, right? At the end of useful life, asset is of lessees. If an asset is not expected to be transferred to lessee at the end of the lease, then depreciated it on the lower of life of asset and lease term. So whichever is lower of. Take an example of a car taken on a loan from company. So car's life can be 10 years, 20 years, but the loan that you have been paying is of 5 years. But since the car would ultimately be transferred to you when the loan is clear, once the loan is clear, so that means this is a finance lease, and then you need to depreciate it over the 10 years or the 20 years, whatever the life is. But it's written that if the car needs to be returned to the I'll say if the car needs to be returned to the company, so then lessee is not getting the car, right? So then you will depreciate it on the lower of life of asset or lease term. So here the depreciation would be on 5 years in just this example. Okay, so guys, these were some generic rules. Now sir, are these rules important? What do you say, sir? Are these rules important, guys? I personally believe that these particular rules are very very important, considering the drafting thing, right? So now what are we left with in this chapter is sales and lease back, right? That how and one more thing, that you have been you have gone, you should do this, right? You should have an idea of this as well. Lessee accounting, because we have covered now this, so you can read this chapter as well. And now we are left with just sales and lease back, and then lessor books as well, right? Sales and lease back, and then we have here lessor books. So these are the two things I'll cover. I'll try to conduct two more 40 or 50 minute sessions, so that you have exactly got what we are left with. But I'll in the same time, if it can be covered in one class, so it's fine, right? So guys, these are the rules that you need to make sure you have an idea, so that you can exactly see what's happening in the question and how you can comment on it, right? So initial direct cost by lessee and finance lease must be capitalized. Yes, now that's something thing that you bought a car, but on lease, but you have incurred some cost as well. The car had some problems, so you incurred to make it into a workable condition. So that's not your asset, it's of your company's, right? You had it on finance lease, but that asset would also be, that cost would also be added into the assets cost, right? That cost would also be added into the assets cost, because it has helped your asset to bring that in the workable condition, right? Because if that is not a cost that's allowing the asset to be used in the workable condition, then it won't be capitalized. But if, since you are the lessee and you incurred some cost to make sure that this asset is being used, so then what will happen, you need to record right to use for that cost as well. So it will be added in the cost and depreciated over the asset's life, right? So another example, life 4 years, lease term 7 years, rentals will be extended to more years, loan will be paid in later years, means liquidity is feasible. So this is something related to the question, so we'll discuss it later, that the past papers that we are going to solve. Okay, so what's we have done till now, so we have discussed leases, right? What is lease, what is finance, what is operating, what's the main message of IFRS 16, why all leases are finance lease, we have discussed that as well, whether it is a lease or not, and we had completed the working mechanism of the leases as well. We had completed the working mechanism of the leases as well. Okay, So this is it, guys. In the next class we'll do sales and lease back as well. Okay, in the next class we'll definitely do this and lessor books as well, and we'll try to cover this chapter. So once these chapters are done, then we'll move on to this question bank and we'll see IFRS 16 questions that we can do. Okay, thank you. Hi everyone, hopefully you guys are doing well, and welcome to another session of technical case study exam, I'll say, or corporate reporting exam, I'll say, of ICAEW. A really, I'll say, interesting paper and a really relevant paper, right? Because this exam, why I always talk about this exam is that this is something that everyone has to go through. This exam cannot be exempted, right? If I just give a brief idea of this, before going on to or resuming the accounting standard that I I was saying, the reason is that in ACCA, right, you go through these papers: FA1, then FA2, these are from FIA, then FFA or F3, then F7 or FR, and then SBR, right? In ACCA you go on to this, okay, right? In ACCA you go into this, and then in ICAEW, once you have taken the admission, the last paper is CR or technical case study. So the paper that you guys are studying now, right, the paper that you guys are studying now is highest level, is highest level of reporting, right? Whenever you are into a corporate world, or in you are in a reporting function, I personally have worked in reporting function, right? Whenever you are in a corporate world, or whenever you are in a reporting function, this paper is the real one, right? You'll see the scenarios, you'll see the reporting mechanisms that have been implemented, like mergers, acquisitions, control establishment, leases, financial instrument. So this is something that always comes into your mind. Therefore these papers are, I'll say, the reporting basics, right? Currently I am teaching you, I'm preparing you for this exam, for the upcoming attempt. And the thing is that this is something very very important, I'll say, because reporting is something, the basics of accounting, right? If you are an accountant and you haven't worked in reporting department, just like you haven't worked in audit department, so there's no value of that. So these are some crucial departments and crucial paper that everyone has to go through. One student asked me that, so in which department I should serve my maximum time of, I'll say, in an entity. So I told him that you should be working in 3 or 4 different departments, then you can decide that where you should do. I myself have worked as in business partnership, like finance business partnership, FBP we say. I have started my career with reporting, and then in planning and budgeting, and then in business partnering. So I will suggest you to go through each department, right? And who is going to get a job in reporting department? The one who has done these papers. They are not just going to get the job, they are going to impress the managers as well, because they'll be knowing many things in that, right? Like when I did this CR paper, I know I was working in corporate reporting, so my job also enhanced. The reason is my job, why my job enhanced, it's simple, because I had done the maximum level of reporting. These are the basics, right? Basics to maximum level of reporting if I've done. So obviously job's gonna be getting great, right? This is the new qualification. I'll say this is the new qualification structure, right? And in advanced level there will be 2 papers. So currently we are preparing for this technical case study, right, which is corporate reporting. Yeah, the ones, those who are appearing for corporate reporting obviously get their technical case study exempted, right? And just a second, you must have these things with you, right? So far we have covered these, I'll say, so far we have covered these standards, so you must be knowing it. And we were in the middle of IFRS 16 leases, right? So this was that we have started, right? And these are the total accounting standards that you should be knowing. So we are currently preparing this IFRS 16. Then I'll go for IFRS 11, this one, right? Joint venture. Then we'll do some different IFRSs before going on to some easy one, right? There are certain easy IFRSs as well, like related party disclosure, borrowing cost. These are very very easy, right? So I'll try to cover the IFRS section first, just like we covered IFRS 5. We IFRS 16 we are going to cover, then IFRS 15 we'll start. So this is it, right? You must be having you must be have taken this ICAEW's orientation, then obviously this ICAEW's CR's orientation. I'll say, right, this is the CR's orientation. I'll write here as well, so that you must be knowing that this is the CR's orientation, and this all PDFs so far done are available, right? Are available on the LMS that you are attempting. And once 3 or 4 accounting standards are done, I'll get you the ICAEW software as well, in which we can prepare, right? So in last class we started IFRS 16 leases. We covered the lessee books, right? And we covered both of the cases, which were the advance case and the accrual case as well, right? We covered both of the cases, advance case and the accruals case as well. So now what we are left with, two areas in IFRS 16. We are left with two areas in IFRS 16. One is sales and leaseback, right? One is this area, and the other one is lessor books, I'll say, right? Yeah, one is sales and leaseback, and one is lessor books. So here are the lessor books. So we need to start at least one area we need to cover. There might be two 40 minutes classes in which this sales and leaseback and lessor area is covered, right? So guys, now what is sales and leaseback? Try to understand this, huh? What is sales and leaseback? Try to understand this. This is something that you are familiar of because you have studied that in your earlier education as well, and this is something that's really really important as well. What is that? Sales and leaseback. That what happened is that this is you, right? You sold an asset because you were requiring the fund, right? Like you sold an car, but ultimately you know that you need the car. So the one that you sold, what you did, the one that you sold, what you did, you leased it back. You asked the seller, or you asked the buyer to please give this car to me and take the monthly rentals, right? So take this car and give this car to me and take the monthly rentals. Now what happened is that in sales and leaseback you are selling an asset. Why? Because you require the funds. In sales and leaseback you are selling an asset. Why? Because you require funds, right? But you need the asset back as well. You need the funds and you need the asset as well. So you ask the buyer that please sell this asset on lease. Please sell this asset on lease. So why this topic is being separately tested or separately written in IFRS 16? The thing is that sometimes the transactions are faked just because of the sales and leaseback. I'll give you the examples later. For now, in sales and leaseback, you should be very, very, very much simpler that we sold an asset just because we needed the funds. But we need that asset again, and we cannot just outflow a huge fund. So what we did, guys, we just asked the buyer to please sell that asset to me. We just asked the buyer to please sell that asset to me so that we can lease it. Okay? So now, in sales and leaseback, what happens? In sales and leaseback, ownership rights are transferred, right? Ownership rights are sold. Why? In sales and leaseback, ownership rights are sold because you have written a contract that I am transferring the ownership of this asset to that person. But since you have leased it back, so whenever you will do the lease, the right to use of lease is yours. That means it is correctly written that in sales and leaseback, ownership rights will be sold. In sales and leaseback, ownership rights will be sold and a right to use will be retained. So that means you are not selling an asset in reality. That means you are selling the right of ownership of assets. You are using that assets. Big companies like I'll say have sold their production plants and got it back on 100 years lease back, right? So this is something really practically implyable. And then I remember when I had a student working in HBL, he was my colleague as well. He was saying that maximum of the banks follow the sales and lease back, right? Because the branches that they have, right, they have initially acquired some of the branches, but then they thought that we have injected too much amount of branch on that, amount of money on that, so we need to lease it back. So what they do is they ask the owner that we need to sell the branch to you and then we'll give you the monthly rentals, please lease it back to us, right? So sale and lease back is something really happening in I'll say practical world, is something really happening in the accounting world, and everyone has to go through it once you are into corporate reporting world. Right? So now so it's simple that the person was short of cash, he was feeling sad, so he sold an asset. But now he was feeling sad because the asset isn't his in his control, so he asked to lease it back, right? So this is sales and lease back. Again, the students, those who are thinking that's a why this question, why this particular segment is separately mentioned in IFRS 16. The thing is that the agreements that are made can be complex one, right? So IFRS needs to address this issue separately, therefore they have done that, right? So firstly, before going deeply into the issues, we'll do this accounting first, right? Before going very deep into the issue, we'll do the accounting. Right? So what is accounting of this sales and lease back, right? What is accounting of this sales and lease back? It's very simple, that if the sale meets criteria of IFRS 15, performance obligation is satisfied. So when we will study IFRS 15, we'll study it later. We don't need to know the criteria, we just need to know that when the IFRS 15 criteria is met. Sir, when we'll study the criteria, when we are into the IFRS 15 world. I'll try to explain IFRS 15 very next to this accounting standard. It's a very important accounting standard as well, and it's one of the major IFRS as well, right? So if the sale meets criteria of IFRS 15, performance obligation is satisfied, right? If the sale meets the criteria of IFRS 15 and performance obligation is satisfied, then you can understand that, okay, we can lease this asset back and the accounting framework can be applied. Sir, for example, like if you are satisfied, you know about IFRS 15's criteria, okay, you haven't studied here but you have studied it before, so you know, okay, the sale is genuine. If the sale is genuine, then obviously de-recognize your asset. If the sale is genuine, my buddies, then you need to de-recognize your asset. The thing is, if the sale is genuine, right, then you need to de-recognize your asset. And since you are leasing it back, so students know it, since you are leasing it back, so book right to use of asset. And what that would be? That would be right of retention of the usage of asset, right? So sir, we'll credit the asset. I will make the entry, don't worry, don't you worry guys. We will credit the asset and we will book the right to use of asset. We will credit the asset and we will book the right to use of asset, right? And what is that? Basically, you have transferred the ownership right. You have transferred the ownership right, but the usage rights are retained, right? And obviously, since you have sold something, then you need to book a gain or loss on disposal according to rights disposed. Then you need to book gain or loss on disposal according to rights that you have disposed, right? So guys, uh, I believe that you have got an understanding that the day you got sales and leaseback transaction, that you'll ask yourself in your heart first question that you'll ask yourself in your heart, that whether the sales criteria are met. Okay sir, but where the sales criteria are written? It's written in IFRS 15. We'll study it later, but you have studied it earlier, so you know it. So if it is genuine sales, in short, then what will happen? Then you will de-recognize your asset. Then what will happen? You will de-recognize your asset. If it's genuine sales, then you will de-recognize your asset and re-recognize the right of use of asset, because you have leased it back. You sold it and you leased it back. So you will re-recognize your asset, and obviously gain and loss on disposal would be recorded, right? And gain and loss on disposal would be recorded. Sir, but the day sales and leaseback arrived. Sir, but the day sales and leaseback arrived, and all of a sudden we realized that this sales does not meet the criteria of IFRS 15. That means performance obligation is not satisfied. That says that this sales does not meet the criteria of IFRS 15. That means performance obligation is not satisfied. Then. So that means that if performance obligation is not satisfied, it's creative accounting is it's bogus sales, then you won't recognize it as a sales transaction. You won't recognize it as a sales transaction. You will no need to de-recognize an asset. You don't need to de-recognize an asset. No need to right to use. No rights needs to be recognized. No gain on disposal. Simply treat this transaction as a loan transaction. Sir, what is this, sir? What is this? If the okay, we got it that if the sales criteria is met, we just need to de-recognize the asset, we just need to re-recognize the right of use of asset, and we just need to book the book the gain or loss. But sir, if the very first day, if we realize that this is not a sales transaction, this is the bogus transaction that examiner is trying to present to us, so what we will do? We will treat it as a loan, not a sales transaction. Sir, why loan? We will treat it as a loan, not a sales transaction. Now a question comes that, sir, why loan? Please explain. Why loan? Please explain. Okay, sure, I will explain. I am here to explain, right? So what I'll do, I'll make some space. I'll make some space so that I can I'll add a page. So I'll give you an example. Okay, I'll add a page here, so I will explain that what exactly I'm talking about. Okay, yeah. So now see, sales and lease back, right? Sales and lease back, uh, fake transaction example, right? Fake transaction example. That's a what happens. I'll write here as well. What happens if performance obligation. So what is performance obligation? We'll study in IFRS 15, don't worry. Is not satisfied, right? What is performance obligation? What if it's not satisfied? So what will happen? So what will happen? It's very simple. Let me give you an example. So here's a person. Uh, he went to bank, right? He went to bank, and in that bank, what he asked that I want to sell an asset. Now read the condition. I want to sell an asset for, let's say, $10 million, right? I want to sell an asset that, okay, and after 2 years, I will buy this asset. Okay, now it's written that after 2 years, I will buy this asset on, let's say, $12.4 million. Okay, now it is written there that this person went to a bank, and let's say if it's a bank, if it's any of the finance provider, any kind of a person who is able to buy this asset, right? So now it's written in a contract. It's written in a contract that asset is being sold for $10 million. Okay, I got the $10 million, but after 2 years, don't sell this asset, please. Don't sell this asset, right? Don't sell this asset. I will come, or I have sold this asset as a $10 million. Okay, I've sold this asset. Now I'm leasing it back. Okay, now I'll write this line here as well. I just forgot to write. Yeah, leasing it back so that I can use, right? Leasing it back so that I can use. So I'm selling an asset for $10 million and then leasing it back so that I can use. And after 2 years, I will come here and give you the $12.4 million and will take the asset back. Okay. So this person has tried to record it as sale and lease back, but one accounting framework that you have studied is something, one accounting framework that you have studied is something that contradicts with this kind of, right, that contradicts with this kind of, I'll say, scenario. What that accounting standard says, so not accounting standard, I'll say accounting principle. Which accounting principle I am referring to, you can write, that is substance over form. This has been told you in the earlier education. What this accounting standard tells you, that commercial reality will always prevail against legality. Commercial reality will always prevail against legality. This is the accounting principle that you have studied when you were a child, right? When you were infant, I'll say. This is that you have studied, that commercial reality will always prevail against legality. Now here the legal form here is that this is an sales and lease back, because I have sold an asset, right? The legal form is that this is an sales and lease back because I have sold an asset, then leased it back. But the commercial reality, right? But the commercial reality here is that this isn't a sales and lease back, my dudes. This isn't a sales and lease back. Commercial reality is basically, I wanted a loan, right? I wanted a loan of $10 million. I got it and I'm paying it back I am paying it back for $12 million or $12.4 million, right? I'm paying it back for $12.4 million. So commercial reality is saying that this is a loan transaction, just the paperwork is involved because asset is not being transferred. Asset is with me, right of use of asset is with me, but asset is with me and there is a condition, then I'll come and buy back. So that means you are not selling your asset or something, you are just faking a transaction so that you get the loan. The commercial reality is this is a loan transaction. Therefore my guys, therefore it was written here that no need to de-recognize asset, you just treat this as a loan transaction because this is a loan. This is a loan. This isn't a I'll say sales and lease back because the condition here attached that I will buy back. So that means that 2.4 million I am paying extra dollar, paying extra. What is that, huh? What is that? Please tell. Is interest. This is an interest, that 10 in 12.4. This is the interest cost that I'm saying. So substance over form is basically, one is commercial reality, one is legality. What will prevail? Commercial reality, obviously. Commercial reality will always prevail. So if, and now what examiner of corporate reporting or what examiner of technical case study do? They'll give you a scenario where the person is involved. You wanted to sell an asset and want to lease it back, but in reality you have asked him to keep that asset ownership with you. I'll come back after 5 years and will get it back. So you need to write that this isn't a sales and lease back, we will follow the commercial reality, so therefore it will be a loan transaction, not a sale and lease back transaction. I hope that you have understood this example. And now the first and foremost important thing is establishing whether this is a genuine sales or not. First and foremost thing is establishing that whether this is a genuine sale or not. Whether this is a genuine sale or not. If this is established that if it's a genuine sale, then you need to de-recognize your asset, then you need to record the right of use of asset, then you need to record the gain and loss, right? And if it is mentioned, or if you realize that this is a fake sale and lease back, so you won't do anything and recognize it as a loan transaction. So why people do this loan transaction and try to record it as sales and lease back? One and only thing, they want to understate their liabilities, because if you are taking loan, your gearing gets high, your interest cover gets worse, your current ratio gets worse. So if you want to manipulate these ratios, you try to do these type of gamings there, right? You try to do these type of creative accounting, but it's the right of auditor, those who have studied this corporate reporting or technical case study, they know about the reporting, so they'll ask you, do not do this. We know this, that this is a loan transaction. How and why there is written, right? How and why there is written that this asset would be turned back to us? Why? Right? Guys, the plan is simple. Once we'll cover this standard, we'll do some ACCA related past papers to have a good grip, and then we'll do the daddy past papers. What are daddy past papers? It's the corporate reporting past papers. We'll do that, okay? It's the corporate reporting past papers. We'll do that. I hope that this is cleared. I hope that this is cleared. Any questions? Right? For your summary, I've also made some notes here as well, that criteria for IFRS 15 needs to be analyzed from the question. You'll read the question and analyze that if this is a okay transaction or not. Okay means genuine transaction or not. Then you'll calculate present value of minimum lease payment. Then you will calculate right to use retained. Sir, how the right to use retained is calculated? Carrying value multiply by present value of minimum lease payment divided by fair value of asset. Obviously, question practice will be done, right? And once you realize that this is a genuine sales transaction, this entry needs to be posted, right? This entry needs to be posted in the ledger. Sir, why bank? Because money is money is entering in your account, so bank obviously. Why right to use? Because right of retention is with you, right? Why right to use? Because right of retention is with you, right? Then asset needs to be de-recognized on carrying value, obviously on carrying value. FLO needs, liability of lease obligation needs to be recorded, right? So if balance come here, right, if balance is here, so on the credit side whenever the balance arise it's gain, and if balance is on debit side so it's loss. So how this will work, don't worry, I'll write how this will work, don't worry, see questions. I'll solve some practice questions with you and everything will be clear. Please tell me that if from here, right, from here till here, are there any questions? Please tell me. My WhatsApp number is with you. You guys are taking the class live as well. So if there's any question, please text me. Yeah, guys. So I believe no questions. I am explaining it very well, therefore no questions are arriving. So it's really, really great that I can see here, right? Yeah. So shall we practice some questions if you allow, right? Don't try to understand this entry. This entry is a self-made once you do the question. So don't worry, huh? Don't worry. You guys take too much tension. Don't worry in that, please. I am here to support you, huh? So now, question 7. Yes, guys. Question 7. Yes, guys. Yes, guys. Question 7. What is it? Fair value of asset is 7 lakh, right? Fair value of asset is 7 lakh. Company sold asset for 7 lakh and leased it back for 4 years at an annual rental of 80,000 per annum. So we sold it for 7 lakh and got the 80,000 per annum in arrears. You know the arrears in advance, right? You know the arrears in advance. So remaining life of asset is 10 years, right? Remaining life of asset is 10 years. Carrying value of asset at the date of disposal is 5 lakh, right? Carrying value at the date of disposal, that means on which the right of use of asset will be calculated, or present value of minimum lease payment will be calculated. Don't worry, you have got the data, you just need to incorporate and that's it. And interest rate is 10%, right? And 50,000 is that required general entry. So I, since this is a practice question, this is made by Sir Basit and team, so this is a practice question. So assume that sales criteria is met. Assume that sales criteria is met, right? Assume that sales criteria is met. Okay. Okay. Now, sir, let's do the practice question now. So yeah, criteria. Step 1 was criteria. So since this was a handmade question, so you need to just assume that criteria is met, right? So this was a handmade question, so you need to just assume that the criteria was met. Now present value of minimum lease payment, so what's the formula of that? The formula is very much simple, right? Present value of minimum lease payment, the formula is very much simple. Future value into discount factor. Future value, that what amount you are going to pay, right, and into discount factor, and discount factor is the interest rate that you have to take, right, and discount factor is the interest rate that you have to take, right, that you have to take. So future value into discount factor, right? 4 years annuity factor needs to be taken up. 4 years annuity factor needs to be taken. You know about the discount factor calculation, so I'm in no worries, right? In the earlier education you have got that. So 80,000 is the payment that you need to make into annuity factor formula for 4 years. You can discount it for 4 different years, or you just can use the annuity factor. It's up to you. You can discount it for 4 years, or you can use the annuity factor formula. So 80,000, and then 1 minus 1 plus r upon minus n and divided by r. So the formula, after filling the values, we got present value of minimum lease payment, that's 253,589, right? Present value of minimum lease payment, that's 253 and 589, right? That's 253 and 589. So that's your present value of minimum lease payment. So criteria was met, present value is being calculated. Now right of use needs to be carrying value of the asset at the disposal date. Is it given? Is it given? Please tell, is it given? So yes sir, its carrying value is given, right? Carrying value is given. And what else you need require in the formula? You require, right, you require present value of minimum lease payment, you calculated it, and fair value of asset. So we have all these three things now, right? We have all these three things now. So here comes right of use of asset. So carrying value of asset at the disposal date into present value divided by fair value of asset. So it's 5 lakh PV MLPVF calculated, and 7 lakh is future value of asset. So it's 181135 right of use of asset. And once my guys, you have got this right to use of asset, you need to make the entry. And entry is very simple. Entry is very simple. First record bank, right? How much money is deposited in bank? It's 7 lakh, sold at fair value, it was written. How much money was recorded in bank? It's fair value 7 lakh. And then after taking cash, what you have given? You have given the asset. So de-recognize your asset, PPNE at 5 lakh. So de-recognize your asset, PPNE at 5 lakh. Okay, de-recognize your asset, PPNE at 5 lakh. You got this? Please tell me you got this. Now right of use of asset, right of use of asset, that's R to you. What are the rights to use that asset? That is your asset. So whenever the asset is recorded, it's on the debit side. Whenever the asset is recorded, it's on the debit side. So right to use of asset is 181135 we calculated. And minimum lease payments, how much payments we need to make in the 4 years, we just calculated into the present value, and that payment need to be made. That means it's a liability. So it will come here. So sir, bank and ROU is here, PPNE and this is here. Add this and subtract this. See where the balancing figure is arising. If the balancing figure, if the BF, if the balancing figure is arising on the credit side, so it's the gain on disposal. If it had arisen at here, if it had arisen at this position, so it will be loss. On the debit side, if the balance is arising, it's loss. And if of the credit side, if if the balance is arising, so it's gain, right? Right guys? Can you confirm me that you have got the answer? Can you, in fact, I would suggest you that this is the entry, take a picture of it. This is the entry, take a picture of it, and then go on to this question, and try to make this question, try to solve this question, right? Go on to this question and then try to solve this question 7, which I have solved, and then try also on question 8, right? Try also on question 8. Simple steps. Criteria, present value of minimum lease payment, ROU, right of use, and then the entry, right? And obviously, this type of questions won't be tested. The real question in ICAEW is going to come later, obviously, right? The real question is going to come later. Try to solve question 8 and question 7 by yourself. I've explained it here, right? Yeah, guys. So let's do now question 8. I hope question 7 is being solved by you. So question 8 is fair value of asset, that's 90,000. Okay, company sold an asset for 1 million and lease it back for 5 years at an annual rental of 90,000 per annum, right? At an annual rental of 90,000 per annum, in arrears, again the arrear case, but here it is more than fair value. The fair value was 90,000, 9 lakh, right? And company sold asset for is 1 million. Remaining life is this, carrying value is this, interest rate is this, and you know the calculations very well, right? So okay, we'll do a question 8 a bit later because it applies to this criteria, so we'll do it later. Another example that you need to do is this: carrying value of the asset at the date of sale, fair value of asset, company sold the asset for the fair value and leased it back for 5 years, and remaining life of asset. Okay, basically when you are selling at an excess amount than fair value, so a separate criteria applies. We'll discuss it later. Just make the entry of it. So is the criteria met? So yes, sir. Currently, as per Sir Bassett's instruction, uh, we are assuming that the criteria is obviously met, right? Fair value of asset is 500. Carrying value of the asset at the date of sale is 300. Company sold the asset for its fair value. If the asset is selling at fair value, you know this case now because the previous one of that, right? And leased it back for 5 years, remaining life is this. Sir, ROUA, what's the formula of right of use of assets? The formula is very simple: carrying value at the asset of the disposal date, present value, and fair value of the asset. Okay. Present value of minimum lease payment is given separately in the previous question. We calculated it. You can refer it back to there as well. So 300 is the carrying value. This is the present value of minimum lease payment, and this is fair value. So right of use of asset is 90. So simple entry would be here that bank is being debited by the fair value of asset because this is the amount that on which we have sold, so 500, and asset is going to be recognized at 300. Sometimes what student does is bank 500, asset 300, and PNL 200, so they won't be getting the marks because they have not taken the impact of ROUA and present value of minimum lease payment, like which is your finance lease obligation. So ROUA is 90. FLO is being given you separately, but sometimes you need to calculate it and you know about how to calculate it. So it's this, right? And FLO is this 150. Okay, so bank, ROUA, FLO, PPNE, and again the balancing figure arrives on credit side. You need to total this and deduct this. So balancing figure if arrived on credit side, so it's gain on disposal 140, right? It's your balancing figure and that's your complete entry. Now sir, why you skip the previous question? This is the case. In above case, asset was sold at fair value. If asset is sold and above or below the fair value, what's the treatment? Huh? If asset is sold on above or below the fair value, then what is going to be the case? What is going to be the case? So guys, very simple. If sold for more than fair value, then excess of selling price over fair value is treated as loan. If asset is being sold on more than fair value, like the case that we have read in question 8, so the excess amount needs to be treated as loan, and obviously loan repayment is included in future lease rentals, right? So loan repayment, if this bottle's fair value is 100 and I have sold it for 200 more than fair value, so that means that extra 100 would be treated as loan as well. And this extra loan has nothing to do with ROUA. ROUA will be calculated on the present value of future rentals, right? Present value of future rentals. Sir, can we do the question so we get an idea? Yes, guys, no problem. Yes, guys, no problem. So question 8. Fair value is 9 lakh and 1 million is being sold by the company. So here comes the question, right? So present value of IFRS 15 criteria is met. Yes, obviously, sir, met. Present value of minimum lease payment. So future value into discount factor. Future value is 90,000, right? Future value is 90,000, okay? Into the annuity factor for the 5 years needs to be applied. So present value of minimum lease payment is 359344. But guys, what happened is, please read this. What happened is that here, what exactly have happened, that 9 lakh is the fair value of asset, and that 1 lakh that you have charged extra, 1 million, oh, you sold it for 1 million and 9 lakh was the fair value. So that 1 lakh that you have charged extra, it will be adjusted from your loan. It will be adjusted from your loan. So see what have happened here is, excess value of selling price of fair value, right? So 9 lakh minus 1 million, so it's 1 lakh adjustment needs to be done. It's basically that asset was worth, understand this, asset was worth 9 lakh and we have sold it for 1 million. So that 1 lakh that we have extra taken, that needs to be adjusted from the liability, that needs to be deducted from the liability. And if we have taken 1 lakh lesser, that needs to be added in the liability, right? So present value of pure lease payment is 259,344. Sir, how this 1 lakh is treated? Just hold on. You will get the idea how this 1 lakh is treated. But just remember this one thing, that whenever the fair value and the carrying value in sales and leaseback is different, one extra adjustment needs to be done. Now ROUA, carrying value of asset at disposal date, it's 6 lakh given in the question. Present value of minimum lease payment, it's given. Fair value of asset is given, so ROU is 172,896. ROUA is 172,896. And then entry would be bank 1 million, right? Bank 1 million, PP&E at carrying value, this is at fair value, right? FLO is like present value of minimum lease payment is this, and a separate loan is mentioned, that this is other loan that we have sold more than fair value. That means 1 lakh is separately treated as loan. This is properly a loan, therefore we deducted it from here. Otherwise what would you have done? You would have added that 1 lakh here, this would be 359, and then this would be amortized, so a treatment would have gone wrong in lease amortization schedule. So therefore the day I realized that that fair value and carrying value is different, I just stopped and adjusted my present value of minimum lease payment. ROU is at that place, so we totaled it, we deducted this, and we again got a balancing figure on debit side. So therefore gain on disposal is here. We again got the debit balancing figure on the debit side, so we got gain on disposal here. You got this? Please confirm you got this entry. If yes, then please try to do just a second. We have done this, right? Yeah, please try to do this example now. Okay, if you have got an understanding of question 8, please try to do this example of sales and lease back. Please try to do this example of sales and lease back. You can obviously take this notes. By the time you would have completed your class, this notes would have been available. Yes guys, take a picture of this question, please. Take a picture, so that picture, please. So now, building, the seller sells lessee building 8 lakh. The carrying amount of the building prior to sale was 6 lakh. The seller leases a building for 5 years for this, and the remaining useful life is this. The transaction satisfies the performance. Most of the times examiner write like this, right? This is an extract of some kit. So most of the time examiner write like this, that the transaction satisfies the performance obligation as well, right? So at the date of sale, the fair value of the building was 750,000. So the excess is 50,000 paid by the buyer is recognized as additional financing provided by the buyer or lessor, and the interest rate implicit in the lease is 4.5%, and the present value of the annual payment is this. Okay, present value is this, and in fact they have given you the present value of minimum lease payment. See, they have done the present value working by themselves, and the fair value is 750,000, but we have sold is 80,000. So that means 50,000 extra that you have got in fair value will be loan separately. This is only the trick here, right? This is only the trick here. I believe that you have got an understanding of this. So, sir, present value was given 526797. Where it is? It's very simple. 526797. This was present value. That was given, right? That was given 526797. Okay. Right? 526797. And then 50,000, that excess loan needs to be deducted from the present value so that amortization is calculated correctly. So it's 476797, present value of pure minimum lease payment. Then ROUS has a simple formula: carrying value into present value divided by future value. So carrying value into present value, and the new present value needs to be used. So ROUA is calculated. Then we need to make an entry. In bank we have got the funds of 8 lakh, and in assets we have de-recognized an asset of 6 lakh. ROUA, we have got this, so needs to come on the asset debit side. Liability needs to come on the credit side, and excess loan that we have got needs to come on the credit side as well, because when you are leasing, no one gives you the extra amount than the fair value. If they are giving, so it's a loan separately, right? So this is bank, ROUA, FLO, loan, PPNE, and then comes the gain, right? And then comes the gain, again adding this and lessing that, so balancing figure is here, so it's the gain, right? So case 2, if asset is sold for less than fair value, then excess fair value should be treated as prepayment. The prepayment has nothing to do with ROUA. ROUA will still be calculated on pure asset, pure value, right? So that means if there's an excess loan, it needs to be, if the more amount is being taken from fair value, so needs to be adjusted from loan. And if less amount is being taken than fair value, so it needs to be added in the present value of minimum lease payment, right? So that means here you are, excess loan is being deducted, right? But if you have got lesser amount than fair value, go on to the question, we have got higher amount than the fair value, so we are deducting from the liability. If we are getting lesser amount on the fair value, so what we will do, we'll add this, I'll say lesser amount, so we'll add this here, and a revised present value would come, So this is it. So what's the condition for lease? Yeah, sometimes this also comes in the question, right? What's the condition for lease? So specified asset should be there, like asset should have a separate specification, like this is an asset, so a separately identifiable, separately specified. Right or use or right to control, right of use and right to control should has transferred to lessee through the contracts and controls and everything, and obviously there should be consideration. This leases cannot be established on free of cost, it should be consideration. So guys, as of now, right, I am saying that IFRS 16's lessee books are finished, right? I am concluding that lessee books are finished. In next class we'll start lessor books. In next class we will start lessor books. So lessee books are now finished. In next class we will start lessor books. You got this? And lessor books are separately, I'll say, books tested sometimes, right? So this is left now, and obviously once lessee books as of now is done, right? Lessee books are done. So once lessor books are done, once we'll do some ACCA past papers, because they are relevant as well. Then we'll do ICAEW corporate reporting past paper as well. We'll do ICAEW corporate reporting past paper as well, right? So I now conclude this session. I believe it has been clear whatever the questions are, and if there are still any questions, if there are still any questions, so +92332623 849. This is my WhatsApp number, right? This is my WhatsApp number. So you guys can text me there, right? If there is any question or any kind of a query regarding ICAEW, regarding the advancement from ACCA, so I am here to support you. Again, this class is valid for both corporate reporting students in the previous version of ICAEW and technical case study students in the advanced version of ICAEW. So this class is valid for both. We have covered the lessee books, which is the major area, and now in the lessor books we'll discuss some criteria separately. Then we'll do some ICAEW's workbook things which have been shared with you, and then we'll do the other questions as well, right? So this is all. Thank you.